South Africa's manufacturing sector is slipping further into weaker territory. The Absa Purchasing Managers Index has dropped to 47.6 in June from 49.2 points in May. This is the lowest level since the middle of 2021. Manufacturing activity is down for a fifth month in a row. All five measures in the sector fell below the neutral 50-point mark for the first time since 2018. The new sales order index slipped as well, lower once more as the decrease in exports widened and domestic demand also remained fragile. Well, to further unpack these numbers, we're now joined by Miyelani Maluleke, the macro-economist at Absa. Miyelani, manufacturing down close to a two-year low. That's during COVID territory there. What is causing the sector to lag behind so much?
Thank you very much for having me. And I think, it's probably going to come as a bit of a surprise to some people, right? Because I think if you think of manufacturing, that's obviously the one part of the economy that we know is relatively energy intensive. For most of June, electricity supply really wasn't bad relative to the 2 months before. In fact, we haven't had anything worse than stage 3 since the 11th of June. So you would have expected that the manufacturing sector would benefit from that. But that's not really what we're seeing in the headline PMI. We've slipped yet again. And I think the real story of what's going on comes through when you look at the underlying data. And what comes through clearly there is that the business activity sub-index, which is of course where you would expect to see the production side of things, actually did improve. It was at its best level in about 5 months. So I think you do see the impact of improved electricity supply there. But what appears to have been the bigger challenge for manufacturers in June specifically was demand conditions. Those deteriorated, and we're not just talking about, domestic demand, but manufacturers are also saying, this weakening global growth cycle is also starting to hurt a little bit because export sales orders did come down. So I think it's really a story of demand conditions weakening to actually more than offset the benefit of improved electricity supply that we've seen over the last few weeks.
When South Africa avoided that technical recession by growing by 0.4% in the first quarter, manufacturing was one of the main drivers of growth in the first quarter. So there's clearly still some resilience from the industry, but what's making it so difficult for manufacturers to sustain the positive output?
Yeah, that's a really good point. I think when you look at the official production numbers, Q1 really wasn't bad. Into Q2, we've already seen the April figures. We're still seeing a little bit of resilience. Load shedding is a challenge, but businesses are having to spend substantial amounts of money. They're having to redirect resources from possibly other productivity enhancing investments into diesel run backup generation, and running these generations can be quite expensive. The cost of diesel, we've seen from companies that report publicly that this cost can run into hundreds of millions of rand, and I think that's really hurting businesses' ability to add productivity gains and actually grow. That I think is really one of the big challenges that manufacturers are dealing with here.
And what are managers saying about output levels as compared to the demand in terms of the market right now? How much inventory is sitting in those factories?
Yeah, so inventory levels did come down a little bit, and which is always, I think, an interesting one because you did see demand come down a bit, in the new sales orders index, and production did go up as well. And I suspect that what they may be telling us a little bit about here specifically is the inventories, is the inputs that they actually need into production processes. That is what, of course, the PMI numbers tell us. But what we're not really able to see is the actual stock levels of finished products. But I would suspect that at this stage, we could actually, in the months ahead at least, we could actually start to see those inventories start to build up a little bit if these weak demand conditions are sustained at the kind of levels that we're seeing right now.
It's a tough one for manufacturers in that South African consumers are under pressure, so not much is being spent at the shopping aisle, so that's why you have those inventories sitting there. So you can't really cut the prices of the own products that you've finished as a factory. So how do they meander this particular period?
It's a very difficult one, because if you look at the last few months, for instance, I mean, we've been talking about inflation over the last couple of years. But one of the things that I think people have generally ignored about the South African inflation experience is that if you look at where our inflation peaked at 7.8%, that is nowhere near what you saw in other emerging markets. Headline inflation got to double digits. And in fact, not just in emerging markets. You look at inflation in the US, in the UK, parts of Europe, inflation went even higher. Ours didn't go that high, and I think that partly reflects the fact that firms have struggled to actually pass on the cost increases that they've seen onto consumers, because consumers themselves are under a lot of pressure. They're not really able to take on those costs. So it's really been squeezing margins for a lot of businesses, and I suspect that we may be in that space for some time.
Well, the local currency had been weak in May until the latter parts of June. Did that help in terms of exports, keeping those prices down?
Unfortunately not, and this is one of the things that we actually hearing from manufacturers in this latest survey. We asked them, trying to understand what's happening to export performance. Did you benefit when the rand weakened substantially? Because of course that should always give you a little bit of a temporary competitiveness boost. But volumes actually did not pick up, not just in May, but also actually into June as well. So it appears that I think the weakening overall in global demand conditions seems to be far outweighing whatever little benefit that businesses are actually able to extract as a result of the weaker rand.
And what's the sentiment like, Miyelani, amongst the managers at factories looking into the rest of the year as we close off?
Yeah, so that was a very interesting one. If you look at the particular sub-index, it's a little bit stronger in June relative to May. But as we've mentioned before, the timing of that May survey was done around that time where there were headlines about the possibility of a total electricity grid collapse. There were headlines about the possibility of sanctions against South Africa as a result of its stance in this Russia-Ukraine war. So I think that fed into that sentiment measure. Right now, of course, those concerns are not there, at least not there as much as they were in May. And you actually did see the expectations index sort of revert back to where it was in April. So the improvement that we see in June, we don't really see it as signaling any sort of fundamental improvement. It's more of sort of technical correction from that sharp decline that we saw in May.
Some concerning news there, with manufacturing being such a great contributor to South Africa's GDP. That was Miyelani Maluleke, the macroeconomist from Absa.